Hello, everybody. Darren Cross here. Welcome to week 6 of Business 149 Business Math. In week 6, we're talking about chapter 7, which is all about discounts. And we will see how all this plays out. I think it's just worth it for us to just dig right in. Okay, so before we get started, we need to kind of understand some terms because these terms are actually going to be useful as we try to figure out what we're dealing with here. So let's start with a couple of these terms. First term is the trade discount amount, okay? So the trade discount amount, when we hear the word discount, what we're saying is it's the amount that we are not going to pay. So it's the amount we are going to save, okay? So the way that we arrive at the trade discount amount, the amount that we are not going to pay, we're going to take the list price, which is exactly how it sounds, the price that's listed, and we're going to multiply times the trade discount rate. So when you multiply the discount rate by the price, you get the discount amount. Okay, so the discount amount is the amount that we are not going to pay. It's the amount that we are going to save. Okay. So in this example, if the list price is $11,550 and the trade discount rate is 25%, we multiply this 25% times the $11,550, and remember we have to convert this to a decimal first. So we drop this and take go 2 decimal points to the left. So it's times 0.25, right? And we have 11,550 times 0.25. And we get 2887.50. Now, here's the thing. This is the discount amount. This is the amount that we are not going to pay. So the amount that we are not going to pay is taken from that list price, the discount amount. So you subtract that amount that we're not going to pay from the list price, and you get the net price. Net price is how much do we end up paying, right? So the net price is the original list price minus the discount amount, the amount that we aren't going to pay, right? So if you subtract that, you get $86.62.50. Okay? So we're going to keep that theme as we go through. The net price is the amount that we end up paying, right? So if you subtract the discount from the list price, you get the net price, okay? Now, the discount rate is the thing that you use to get the discount amount. Makes sense. You use that rate, multiply times the list price to get your discount amount. The discount rate gives you the discount amount. That's why they named it that way. Okay? So let's keep going here. All right. So, single trade discounts and complements. Understand that when we get the discount rate, that the complement of that rate is when you subtract this rate from 100%. So the list price is going to be 100%. The discount rate is 25. So the complement of that is 100 minus that 25, which is 75. Why is that valuable? Because instead of figuring out what the discount amount is, so we have an amount that we multiply times 25, and we say, okay, so now I know my discount amount, but I want to figure out my net price. What you can do is just multiply the list price times the complement of the discount rate, and you'll get that'll actually tell you what your net price is, right? So if I'm paying $100 for something and I'm supposed to get 25% off, that means that I have 75% on. So it's 75% that I am going to pay. So what you can say is, let me multiply this 75% times that $100, and that's my net price, right? You got to keep these right in your mind. The discount rate is how much you are not paying, okay? And if you take the complement of that, and the complement just means what does it take to make a whole, right? That's not just for this. Complement always means what does it take to make a whole? How do we get to 100%? Now, supplement, don't write this down because it doesn't matter right now, but supplement is, okay, what can we supplement or add to that 100%, right? But complement is always, how do we get to 100%? Okay, so the complement, in order to get to 100%, you have to complement this 25% with 75%. That's going to be useful if we want to avoid that step of subtracting once we figure out what the discount amount is. Okay, so the single trade discount, the discount amount in dollars a retailer receives when only one discount is given by the manufacturer wholesaler. So this is the discount amount. It's the amount that we're not going to pay. All right, now the single trade discount rate is the rate, the percentage rate that we're not going to pay, right? So it's not the amount, it's the rate. And we're going to use that when we're doing our calculations. Okay, the complement is the difference between the single discount rate and 100%. That's the complement rate. And like I said, that's going to come into play. So when we look at this, when we look at this, the trade discount is 25%. So that means this is how much we're saving. How much we're paying is 75%. Okay, so let's put it into play. The price of a Macintosh computer is $2,700. The manufacturer offers a 40% discount. What does that mean? That means 40% of this we are not going to pay. What are the trade discount amount and the net price? Well, there's a couple of ways that we can actually do this. First of all, we can solve using two steps. Find a discount amount. We have the discount rate, so we can find the discount amount. The discount amount, like we said before, is the rate times the list price, right? So 2,700 times 0.40, that's how we would do it for the math, is 1080. So 1080 is our actual discount. They're asking what our discount is, so that's what the discount is, all right? What are the discount and the net price? So the discount is 1080. How do we get the discount amount? Well, we took the discount rate times the list price. So we got the discount amount. Now we want to know the net price. And the net price is how much do we end up paying after the discount? So then we have to take this discount. We have to subtract the discount from the list price. 2,700 minus the discount is 1,620. Now, the other way that we can do this, and this is why this complement is so important, is because another way that we can do this is just by, instead of using this to do the two-step method, we could use a one-step method by just saying, okay, well, let's just multiply times the complement of this to get our net price, right? So this is if we're only looking for the net price, though. So the net price is 2,700 times the complement of this, which is 0.60. 2,700 times 0.60 is 1,620. They asked for the discount amount and the net price, so you might as well do it this way. But if you're just trying to find the net price, I would just go ahead and say, okay, well, if I'm saving 40%, then that means I'm paying 60%. So 2,700 times 60%, 2,700 times 60% is 1,620. Okay, so let's talk about FOB. FOB is a term used in shipping to determine who is responsible to pay for items that are shipped. The origin of it comes from when we used to ship things on ships, and FOB stands for free on board, but it really, I don't like the fact that they said from a buyer's perspective. It just means if it's FOB shipping point, that means the buyer is paying the shipping cost or the freight cost. And if it's destination, this is also called origin. So if it's FOB origin or FOB shipping point, that means the buyer pays the freight cost. When the buyer pays, like when they buy this thing, they also pay for shipping, right? And FOB destination means that the seller is paying for freight costs, and they're assuming liability for anything that happens. That's going to come into play when you're trying to figure out the cost of things. Based upon what that is, you have to attribute that cost to the right person. Okay, so sometimes we're going to be looking for the list price of something when we know the net price, the amount that we're going to end up paying, and we know what the discount rate is. So it's like, this is what I always do when I argue with my wife, right? So I'll say, she'll come home and she'll say, "Hey, I saved $50 today," or whatever, or "I saved 20% today." In her mind, that's awesome, but my deal is, how much did you spend? In other words, how much money did you actually spend? She speaks in terms of how much it was listed as, right? So her deal is, well, it was $1,000, but I saved this. So how do we arrive at that original list price when you only know what you end up paying and what the rate is? Well, you do a little bit of trickery here. What you do is, that list price is going to be whatever you ended up paying divided by the complement of that discount rate. So whatever that discount rate is, you take the complement and you divide it into the net price. So back at that computer, right? The Macintosh computer has a $16.20 net price. We determined that we ended up paying $16.20, and it's a 40% trade discount. What was the original price? This can come in handy when you're trying to get deductions and things like that, or if shipping is going to be based on the list price, you need to know what that list price is. There are lots of times when we might need to know what the list price is, even though we paid something different. So what we do is, we take the net price, which is $16.20, and we divide by the complement of that discount rate. The discount rate is 40, but we're dividing by the complement of it, which is 100 minus 40, which is 60. So when we do that, we come up with 2,700, which was what they told us in the beginning. Okay, now chain discounts. Chain discounts are a series of discounts. It's two or more discounts in a chain that apply to a specific purchase that you're trying to make. Now, at first glance, we would say, well, if we have a 20% and a 15 and a 10% discount, that would be, let's see, 35, 45% discount. No, it's not a 45% discount, because what happens is, you get the 20% discount, and then you get the 15% discount off of whatever's left, and then you get the 10% discount off of what is left, right? So you don't just add up the discounts. You have to take these and work them individually, right? So if something costs $15,000 and you have chain discounts, 20, 15, and 10, you would take 20% off of that 15, right? Which is $3,000. So you subtract $3,000, you're left with 12. Then you take 15% off of that, which is 18. You take the 1,800 off, you're left with 10.2. Then you take 10% of that, right? If it was going to be 35% or 45%, it would be nearly half. But we see that it's not nearly half. We end up paying, something like around 40%, not 45%. But there is an easier way. These are the discount rates, but what we do is we actually calculate the net price equivalent rate. And what that is, it's the decimal equivalent used to avoid having to do 20%, then 15%, then 10%, right? What we do is we actually take the complements of all three of those rates and multiply them together. So instead of that 20% discount, we take the complement, which is 80. The complement of 15 is 85, and the complement is 10 of 10 is 90. We multiply these together, and we get our net price equivalent rate. Here's why it's called the net price equivalent rate. Because when we use this new rate, it helps us discover our new net price. So really, we're paying 61.2% of that original price. Okay? So it would be, if we take 20 plus 15 and 10, that would be 45, which means that we would be paying 65%, right? 0.65. We're not paying that. We're paying 0.662. Or we would actually be paying more with this kind of a situation. So this is the equivalent interest rate that we're going to use in order to figure this out. Okay, so 15,000 times that 612 is 9180, which is what they came up with. So what was the discount amount? Well, if we end up paying that, you take this discount, you take this from the original amount, and that's the discount that we actually got. All right, so the single equivalent discount rate. Here we were talking about the net price equivalent rate. This is the rate we use to figure out the net price. That's why they call it the net price equivalent rate. Well, here we have the single equivalent discount rate. So it's basically the single or the equivalent discount rate, right? So this is the discount rate. Here we're trying to figure out what the discount rate is, right? Not what the net price rate is. We're trying to figure out what the discount rate is. Well, if the net price equivalent rate is the amount we're going to pay, then the amount we're going to save is 1 minus that, right? So this is the net price equivalent rate. If we subtract that from 1, we come up with 0.388. This is our effective discount that we're getting, 38.8%. So instead of that 45% discount, we're actually, the 45% discount is more than what we're actually going to save. We're only going to save 38.8%. I mean, think about it. If you have 2 chain discounts that are 50% each, do you think you're going to get that item for free? No. You're going to get 50% off and then 50% off of that. So you're going to end up paying 25%, right? It's not going to be, I got 50% from the entire store and 50% from the men's section, so that means it's free. No. It's 50% off from the men's section. So if my item costs $100, that means from the men's section, I have to pay 50, but then I get another 50% off of that, which is 25. So now I'm only paying 25. So you have to take into consideration those discounts individually. Okay, so keep in mind that the net price is how much we pay. The discount is how much we actually save. So when we think about that in those perspective, the net price equivalent rate is how much is the rate that tells us how much we're going to pay. And the single equivalent discount rate is the amount that tells us how much we're going to save. And of course, if we're going to pay it, then we subtract that from the whole cost to tell us how much we save. That only makes sense. Okay, so let's talk about cash discounts for prompt payment. Okay, so whenever we are buying something, particularly when we have like net 30 or net 60, or this isn't traditional credit. Basically, we buy something from a vendor and they say that we have 30 or 60 days to pay it. Okay, but they want us to pay it as soon as possible. And here is a rule that you should have for your life, but businesses have this rule as well. Think about this. When do you want to pay something? As late as possible. Never if you can get away with it, right? You want to pay something as late as possible. When do you want to get your money? You want to get your money as soon as possible. Well, businesses want to get their money as soon as possible because money now is worth more than money later. So as a result of that, they are willing to give you a discount if you pay sooner. Okay, so when we're talking about cash discounts for prompt payment, what we're doing is we're saying, and this is actually just for the item that you purchased, right? So you buy something and you haven't paid, and they say, hey, if you pay earlier, we will give you a discount, right? There are 2 things to take into consideration. The first thing is that you have this credit period. The credit period starts on day 1 and ends usually, it tells you when that ends, but it's usually 30, 60, or 90 days, right? And we'll talk about how to know that here in a second. And then there is a discount period. They also tell you what the discount period is, right? So the idea here is if you see this is March 10th, so March 10th is about right here, right? So there's an entire credit period. So this is the total amount that you have to pay this thing, but they're saying, hey, if you pay it within 10 days, we'll give you a discount. And here's how it looks. Well, this is a typical invoice, and let's see. So they say net amount due received by 7/10, 12/05, right? So this is something that was 12/24, but if you pay it, you can save this 19 cents if you pay it within 10 days, right? Or actually, we'll talk about why they did this, but if you paid it by the 10th. So the types of credit terms that we are going to see are going to be either ordinary dating, receipt of goods, and end of month. Receipt of goods, you'll see ROG after the terms. End of month, you'll see EOM after the terms or as part of the terms, okay? Now, this is what you see here. This is ordinary dating. What you'll see is something like this. So you'll see 210 in, and then this number. This could be 30, 60, 90, something like that. And the way you say this is 210 net 30. If this was 60 right here, then it would be 210 net 60. And what they're saying is we will give you a 2% discount if this is paid within 10 days. But no matter what, the entire thing is due in 30 days. Okay? So you get a 2% discount off the gross amount of the invoice if the buyer pays the bill within 10 days of the invoice date. If the buyer misses a discount period, then they submit the net amount without a discount between day 11 and 30. So if you pay after this 10th day, then you have to pay the entire amount. The whole thing is due within 30 days. Now, all we see here is 210 net 30. So we are assuming that we have this discount of 10% within 10 days. Well, 10 days of what? If it's an ordinary dating method, it's 10 days. What did they say? 10 days of the invoice date. Okay? So whatever date is on that invoice, if you pay it within 10 days, you get this discount. 10% or 2%. Right? So you get a 2% discount if you pay it within 10 days. All right. So let's look at this. The date of the invoice is July 5th. That means that by July 15th, if you pay it, you get that 2% discount. But the whole thing has to be paid by August 4th. 30 days, right? 30 days. So let's look at this calculates it for you, right? So a $400 invoice dated July 5th, terms 210 net 30. What does that mean? It means all you see is 210 net 30. That means it's ordinary dating. It's paid on July 11th. No freight. We're not concerned about freight. So what do they actually have to pay? Well, it's paid on July 11th. July 11th is within this 15. So they pay that $400. Times 2%, they get an 8% cash discount. So you subtract that from the $400 invoice, and they only have to pay $392. $392 is the amount that they owe. Now here they multiply times the complement. That was a quicker way of doing it for them. Okay. So it's important when we're trying to figure out this discount. We're trying to figure out when is the first day that everything else is based off of. If it's ordinary dating, it's the invoice date. Okay, so let's look at ROG or receipt of goods. And you can tell that it's receipt of goods because you'll see ROG after the terms or as part of the term. So this is 310 net 30 receipt of goods. What this means is you'll get a 3% discount if paid within 10 days, but it's due within 30. And what does this ROG really mean? Well, it means that the first day that we start counting for all of this is the day that the receipts are or that the goods are actually received, not the invoice date. It's the date that the goods are received, right? So you get a cash discount when the buyer receives the goods, not the invoice date, right? So if we go back, it's not this date. It's going to be some date after this. It doesn't matter what the invoice date is. It matters when it was received. Okay? So you get a 3% discount off the gross amount of the invoice if the buyer pays the bill within 10 days after the goods are received. So this starting date is something else. You start here with the date that it's actually received, and then you start counting 10 days. Okay? And then you go to 30 days to figure out when the whole thing is due. If the buyer misses the discount period, then they submit the net amount between day 11 and 30 of the receipt of goods. So let's look at this. $900 invoice dated May 9th. So the invoice is actually dated May 9th. If this is ordinary dating, we would start counting from that May 9th. But it's not ordinary dating. It's the terms here, as we see, is 310 N30 ROG. That means receipt of goods. We start counting this 10 days from the date that we received the goods. So when did we receive the goods? July 8th. So this first date is July 8th. And we got 10 days to pay. So between the 8th and the 18th, when did we pay? July 20th. We don't get a discount because we paid after this discount period. So we pay the full amount of $900. Okay, end of month. This gets a little bit tricky because there's two things that you'll see. You won't see net 30 because it's kind of built into here, right? So 110 EOM is read 110 end of month. And you do have to go back to the invoice date, but you're not basing everything on the invoice date. You're basing it on the end of that month. And when we say the end of the month, we're saying the last day of the month. Okay, so everything is based on the last day of the month. If the invoice is dated the 25th or earlier, so if you look at the invoice and it says, oh, this is the 24th, then you get a 1% discount up until the 10th day of the following month. So in other words, you start counting from the last day of that month. Right? So if it's October 23rd, you start counting your 10 days on October 31st. So you have till the 10th of the next month, right? The 10th of November. Okay? So you get that discount period up to the 10th of November. The discount period is missed. The buyer pays within the next 20 days after that. So you still have 20 days from the last day of that month, right? So it's still 30 days. Now, the invoice is dated after the 25th. This is a different scenario. So now it's October 26th. The last day of the month does not start on October 31st. The last day of the month is the last day of the next month. That's when the 10-day period starts. So the discount doesn't start on October 31st, or the counting doesn't start on October 31st. The 10-day period starts on November 21st. So you can pay anytime up until the 10th of December, right? So you have up until the 10th day of the next month, the second month, right? And then, of course, if you don't pay in that discount period, you pay in the next 20 days. If this is effectively, it's kind of weird, but it's effectively a net 30 contract, but it all depends upon when you have a little bit more than 30 days, no matter what, but it all depends upon what day it's invoiced, okay? So your discount period your discount period and your credit period starts either at the end of that month or at the end of the next month, depending upon what day it is. If it's 25 or earlier, then your period starts on the 31st of this month. If it's after the 25th, then it starts on the 25th of the next month. So let's look at the scenario. $600 invoice dated July 6th. So the invoice date is July 6th. No freight or anything like that. The term is 110 EOM, and it was paid on August 8th. The invoice dated on or before, invoice dated on or before the 25th of the month. All right, so this is before the 25th of July. So that means that our start date for calculating everything starts on the last day of that month, the last day of July. So this is the date of the invoice, but we go to what are they saying here? We go to the last day of that month. I wish that they did this. I wish that they said July 31st here. And then once you start to count, then your discount period ends August 10th, right? So you go to the last day and then you start counting. And your discount period is 10 days from the last day of that month. Since this is the 6th, we go to the last day of July. So this should be like July 31st. And then you have 10 days to pay that. And then you have another 20 days. It's always 10, 20. You have another 20 days to pay the whole thing. You won't get the discount, but you can pay the whole thing. Okay? So they paid it. They paid it on August 8th. Well, August 8th is within this period, so they get the discount. They paid $600. They get the 1% discount because it was paid within 10 days of the end of the month. So they get a $6 discount. This is all they have to pay. Now, the other scenario is if this is actually after the 25th. So this is an $800 invoice dated April 29th, no freight. It's a 2% discount if paid within 10 days of the end of month. The payment was made on June 18th. Note, the invoice is dated after the 25th of the month. So what this means is that this start date is not the end of that month. The start date is the end of the following month. So it's the last day of the following month. So this is dated April 29th. It's not April 30th, which would be right here. You go an entire new month, and you go to June. Is it 31st? No, June 30th, right? I think June only has 30 days. So, I may be wrong. Oh, no. April, May, June. Yeah, so you go to the end of May. Sorry, so you don't go to the end of April. You go to the end of May, right? So the last day of May, which means you have 10 days from the last day of May, the discount period ends on June 10th. And the 20 days later, June 30th is the last day, right? So when you look at this, the payment was made on June 18th. It was made after the 10th, so they don't get the discount for that month. You got to understand that when you're dealing with end of month, does your first day of counting start at the end of that month or at the end of the next month? You have to keep that in mind at all times. Okay, so let's say somebody makes a partial payment. How do we actually do that? They make a payment. So Molly McGrady owed $400. Her terms were $210 net 30 within 10 days. So within that 10 days, she made a payment of $80. She didn't pay the entire balance. She just made a payment of $80. So what do? She gets a discount on this, but what do? Well, what we do is instead of crediting her just the $80, we got to credit her a little bit more than $80. So what we do is we have to find the complement of this discount rate, right? So the discount rate is 2%. We find a complement, and then we multiply this $80 by that complement. By multiplying $80 by the complement, we come up with the amount that we should really discount this, right? You would think, well, 2% of that $80 is just 1.6, $1.60, but it's a little bit more. And you might think this doesn't matter right here. But it does if you're dealing with millions of dollars, right? So instead of saying 2% of this and let's add that amount there, we just divide, instead of multiplying by the rate, we divide by the complement of the rate. And we get the true credit that we're going to have on that account. So she owed $400 and she paid $80, she gets a discount. So what we do is we actually, instead of saying we're going to go ahead and credit you with 80, we're going to credit you with a little bit more, and that tells us how much we're going to have left, right? So when you subtract that 8163, when you subtract that 8163 from the 400, you're left with 318.37. That's how much you actually owe instead of the 320. You owe a little bit less. Okay? So, I know this stuff is a little bit maybe confusing. So, if you have any questions with this stuff at all, feel free to reach out to me. Text me. That's the easiest thing. You guys are messaging through the app or through Canvas, and that's fine, but I might not see it right away. If you're having problems or you're challenged by some of this stuff, text me. I can do what I can to help you. And, I think I can walk you through stuff. Again, a couple of weeks ago, I actually asked if you guys wanted to do a live chat. A couple of people said they did. Nobody actually showed up. But if you guys think that that's something you want to do, reach out to me and I can jump on a Zoom with you. We can help figure this stuff out. But if you save this video, watch it, slow it down, I think that you'll be in good shape. If not, just let me know. Either way, good luck and let me know if you need my help.